Hi, I'm Debra Beck-Mewing from the Property Frontline.
Hi, I'm Ken from Avvora Finance.
And I'm John Gilmovich from Real Property Manager. Welcome back to Property Mythbusters, where the motive here is to bust some myths around property buying. And every fortnight we take you through the markets, and we also uncover some of the myths, confusion, and misconceptions, I guess, in the property buying marketplace. So it's been about just over a fortnight since our last meeting, and a lot's happened. A lot's happened in the markets, including our federal budget.
Yeah.
So I'm going to walk you through the rental market and see what's happening in our capital cities as well as our regionals.
You're going to share your screen, John?
I'm going to share the screen right now.
Mm-hmm.
I'll just bring this up.
Ooh.
So with if we're deep diving into just a bit of data and statistics, though we are now in October, the rental data does lag behind about a month. So this is what's happened last month during September. And of course, we rely on our favourite data researcher, Louis Christopher from SQM, who we thank very much for bringing the data up. And so generally what's happening, as you see the headline there, nationally we're remaining stable, but our two major capital cities, Sydney and Melbourne, and in particular Melbourne with their hard lockdown at the moment, is having some adverse effects on the rental market. And Sydney was leading pretty much all this year as far as the highest vacancy rates, but now Melbourne has taken over with the highest vacancy rate for rentals in the country, and no surprise there because they're still in the lockdown situation, and that's having obviously that adverse effect on the on rental prices and possible movement from their from Melbourne out into the regionals from affordability point of view. So as you can see there, there's been an increase from 3.4 to 3.8% during one month, and that's adding extra stock. So these stats are based on the current rental listings that are online through domain and realestate.com. That's where this data is actually drawn from. So we've got an extra 2,300 properties there that came onto the market in Melbourne and in Sydney. We've been stable at 3.5%, but 3.5% still represents an oversupply of rental property. 3% is where demand equals supply.
Can I just jump in there? Because I always thought it was 2%.
No, it's actually 3%. About between 1% and 2%. Debra, generally the rental market is ticking along quite well.
All right.
As soon as it starts heading towards that 3%, generally you're generally in oversupply, more stock than demand, and of course over that we start getting the rental drops. Rent reductions start occurring as investors start discounting to compete, basically to compete.
It's very nuanced, isn't it? Like not much.
Yeah. So the capital cities there, Sydney and Melbourne, continue to gripe with an abundance of rental stock, in particular the inner city and the CBD marketplaces, where there is continuance of tenants exiting the rental market, going for more affordable and more regional out in the suburbs, and more regional stays where basically they can continue to work from home. They don't need to commute into the CBD. So that kind of all makes sense from, trying to save some money, possibly saving money to go into their first home purchase. And you can see even sort of, have a look at Canberra, for example, Deborah, you can see there record low vacancies there. Employment there is pretty stable. And it is the highest paid salaries in the country. So it kind of makes sense that kind of great stability lifestyle and security of employment right now for them out in Canberra is producing some of the lowest vacancy rates in the country. So some commentary around that. You can see that rental vacancy rates in Sydney and Melbourne are still in the downward trend, and Sydney and Melbourne vacancy rates are starting to ease a little bit. Brisbane CBD itself still is up high in the vacancy rate, but regional Queensland isn't. So there's kind of that whole disparity going on at the moment between inner city living and outer suburbs and regional. Vacancy rates are like chalk and cheese. So really just boiling down to that supply and demand situation that's going on right now. Yesterday in the media, article came out, cheap rents, attention-grabbing headline, where tenants are getting the biggest discounts on their rental homes. Aidan Devine from Domain commentary makes a lot of commentary around property matters, and you can see there confirming that this is focusing on Sydney. That there's been a further 7% drop in an overall of 26% cheaper than a year ago in the CBD on those rents, and I have seen that for a fact that there have been some substantial drops because just the demand is not there, and the CBD is currently a ghost town. But even the surrounding suburbs, what we have always known as the blue chip suburbs, Surrey Hills, Darlington, Pyrmont, Darlinghurst, all those trendy inner city suburbs are also struggling and off the ball 20%. So it is a tenant's market in those areas right now, which is great news for the tenants, but not terrific news for the property investors. And of course, probably why property investors are backing off at the moment, jumping in, purchasing, because the yields are actually falling. So Deborah, unless they're picking up an absolute bargain off an inner city apartment, you just wouldn't be jumping in right now because the yields are pretty low, and could be lower. So the other announcement in the last couple of weeks has, of course, investors have been holding their breath about the rental moratoriums around the country, and tenants having that protection ring for their tenancies. So it was announced 23rd of September that particularly New South Wales, which has followed Victoria and Queensland with extending their rental COVID-impacted moratorium on tenants till the 23rd of March next year.
But Queensland said it would end it's ending. It's different.
Yeah, so Queensland government announced that it would end the eviction moratorium on the 30th of September, but there are other protections in place up until the 31st of December. And also commercial and retail property, those moratoriums have been extended as well. So the general national view across the East Coast has been to continue to protect the tenants from being evicted for non-payment of rent, and for landlords and tenants to work it out with each other what the road forward is if they are struggling or COVID affected with income losses, and the key indicator is having a 25% or more loss of income in a household, and that includes the your JobKeeper and JobSeeker payments as well, a part of that income.
Yeah.
So Deborah, sum it up. Still pressure there in the inner city markets for landlords who are discounting rents to try and obtain the limited number of tenants. We are in fact missing that influx of migration. That's kind of the general key and the driver behind a lot of demand for accommodation. And we currently have somewhere along the lines of about 170,000 deficit migrants in our capital cities, and about 350,000 it's been estimated across the whole country of people not coming in. And that's skilled workers and those with work skill visas and the students and all of that that generally take up the accommodation.
Yeah. Okay. Alrighty. Well, I will. How can I? So I'm just going to take back your screen. I think if I can. Right, got you. All right. So let me jump into my side of things. On the migration side of it, I think that is really the space to watch, because, we had a lot of expats come back that may never return, and I don't know how those numbers, have balanced out the lowered immigration. And we know that the federal government is working on a bit of a plan. I think it was held back a bit, but certainly at the start of next year, they'll be working on a plan to entice more migrants, or, re-encourage or reactivate that side of it. Do you have any insights into the balance between the expats returning to take up the loss of immigrants, John?
Yeah, so I do have some clients which are expats, and I rented out their homes in Sydney. I've had a couple who've made inquiries about coming back. Some of those expats are in the UK and the US. And they were pretty eager to come back.
But they couldn't get flights?
They couldn't get flights, of course. I can't say there's been a sort of a surge of inquiry on that front, but certainly there has been some discussions and inquiries about the possibility to come back. And that's more from a family unity sort of situation with
and see, I think they're hidden numbers, so I think that's a kind of watch this space. But so from my market update, from the buying perspective nationally, indicators are we are really at the like the market is set to explode, which is what the government wants. And do we need it? Maybe not. So just reviewing some of the data, this is one of the amazing graphs that realestate.com, but their researchers have been putting together. And so you can see here that the buyer demand, as by the way they measure it, which is, you know, the amount of people who are downloading a property or the time people spend looking at property. So all of the little indicators that they measure to use buyer demand. So they're saying that that is really up. So you can see here, like we started the year in a really, really hot market. We hit the COVID wall, and that just sort of happened, like this dip occurred for just a couple of weeks and then bounced right up into the stratosphere when, you know, we passed that first round of lockdown, and then it's gradually started to ease. But the easing, of course, is masked because this is a national total. So while the majority of states and territories sort of kept pretty consistent, it really is the Victorian numbers that have made it look like it's dipped or eased. But of course now Victorian activity is really starting to come back. But like the fact that we were run off our feet here and people were paying crazy amounts for purchases in that, like it was, I'd say October 2019 to March 2020. If it was crazy then, what's this? What's this going to do to prices? But anyway, so buyer demand is up. Stock levels, I just didn't have time to get to my organise my charts today, but stock levels, and these are the latest data from the RBA pack. So yeah, stock levels are consistently low when compared to other years. So this is no doubt due to the fact that people who might be in a precarious financial position aren't being forced to sell, but we also expect that people don't really want to put their house on the market and have potential, you know, COVID cases walking through their house. So I think stock levels are going to stay muted for a little while. Then as far as what the data is saying, without wanting to steal your thunder or anything, Ken, from an investors versus owner occupiers, you know, so who is buying, you can really see that there's the investors have really kind of dropped off a cliff. But this is great for the owner occupiers and your upsizers, first time buyers, all of that kind of thing. So there's really such a big difference between the type of approach. Portion of new lending for investment housing, it's really gone down, but
down and sharply down.
Yeah, but yeah, and this really kind of started with that easing of cash. I won't talk about it because I know you're going to again. But like, look at this. So we are starting to see that little bit of a bounce. Anyway, so the other thing I wanted to mention, so today, or actually yesterday, 14th of October, the Westpac Consumer Sentiment Index came out, and just a massive vote of confidence after the budget. And yeah, they also published the results of their survey, which, just to note, it's based on a survey from 1,200 adults. I know that's supposed to be a legitimate search, but I just, yeah, don't really think that's such a reliable sample. But anyway, so they're saying that people intending to buy a dwelling, that has experienced a strong bounce. And yeah, all of this is really just contributing to a mix where we'll start to see prices really start to take off again. So it's really like just after the federal budget, the federal election in 2019, when it was kind of like a free-for-all and people were paying, you know, like 30 or 40% over asking prices. We could start to see that again. But anyway, and so Ken, what's happening with your side of things?
In the credit space.
Credit space.
I think the biggest thing is that there's government's put forward the notion to remove responsible lending. It's an act was kind of put in place post GFC to make sure. I mean, you know, with the GFC, there was the subprime mortgage crisis. There was a lot of loans given out for people who couldn't pay that. So I think to just to give a bit of context to prevent that situation from happening here, the responsible lending rules were put in place so that, you know, banks needed to make sure that they were lending credit to borrowers responsibly.
So now they can be irresponsible.
Yeah, 12 years later, you
Right.
know, things have changed. I think the stance has changed, and like from a broker's perspective, it was quite interesting to see, you know, the tightening of regulation policies, things like that, and how that actually drove lender behaviour.
Oh yeah.
Behaviour. It did get to the point where they would be doing, you know, some forensic accounting, you know, going through lines of transactions and questioning, you know, the client who transferred some money to their parents. It wasn't a regular amount, a flat amount.
Sorry. Yeah, go on.
Yeah, and you know, we're talking like $38.17, things like that. Like,
Oh my God.
But it was not a round number. And yeah, they would pick that type of stuff up and say, you know, what was this transfer for? And, you know, you need to explicitly state it's not a repayment or anything like that.
That's ridiculous, I think.
Yeah, so it was interesting. I mean, and, you know, from a lender's perspective, they were just making sure that they were covering themselves and, you know, not getting into trouble in that sense. And yeah, it did start to get a bit cumbersome because I think from my understanding, the idea to kind of remove the responsible lending is to kind of free up the administrative burden that the lenders have to go through to verify all the information, and they're putting the onus and responsibility back onto the borrower to make sure that the items that they are declaring is correct. So there is, so basically they're making, because prior to NCCP, you know, the amount, your living expenses, let's just say, usually was just a flat amount that you need to declare. So it could be like $2,300 per month. That's it. Since responsible lending came in, that then kind of needed to be itemized. Each lender had their own category in terms of how they would categorize expenses, and then they would then verify that those payments from your transactional account. So I think it will reduce the amount of documentation that needs to be provided, but I don't know what that's going to look like for their credit policies and whether they would stay in place or not, because, you know, lenders, when they're creating their credit policies, they've got a couple of things that they'll things to consider before making decisions on how they want to lend and what they're looking for in an application. Sometimes it's a risk. The idea of managing their risks, so making sure that you're lending the money out to people who can repay it, because basically no one really wants a loan that will default. It becomes really messy really quickly. There's also sometimes there's commercial aspects to it. So they want to increase market share, let's just say, compared to a competitor. So they might ease a little bit more. They're not, they don't have concentration risk where, you know, they're spread out on a lot of, they're lending out a lot of money to maybe, let's just say, newly built places. Maybe that could be also an item. So there are a lot of things that, yeah, the lenders could do without having, with the focus now reshifting back to borrowers and applicants, making sure that they're, you know, doing the right thing. And I think this will help in terms of, from a broker's perspective, I guess, giving advice to clients and help guiding them through the process in terms of what they can, can't do, what are some of the risks involved in terms of, you know, going ahead. Just because you can get a loan doesn't necessarily mean you should in certain circumstances.
So Ken, there's been a shift. Obviously, there's been a shift now, by the sounds of it, from responsible lending to responsible borrowing.
Yeah.
Is that what's happened?
Yeah, essentially, that's a pretty good way to sum it up.
Yeah.
So yeah, the borrowers, it's I wouldn't really say borrow beware, but you know, there's two lines of thoughts from what I can from what the information that's coming through in the articles. One is that this is a bad thing because, you know, people are going to take on board more debt than they can support.
At historically low rates.
At historically low rates, when if it were to go up, you know, how are they going to manage those repayments? So that's one side or one perspective. Another one is for applicants who were previously capped at what they could do, or the lenders and the borrowers were kind of capped at what they could do, even though both parties, you know, were well aware of the risk. There will be integrated risk on both sides, but because of the regulation, they wouldn't do it. So, you know, yeah, there's pros and cons. Some people will be, it depends on which, what your take is on it, I guess. But it'll be, for me, I'm curious to know how that's all going to play out in terms of, because banks are actually really, from what the vibe that I'm getting from lenders at the moment, they are actually quite cautious. They're a bit risk adverse in terms of the lending and things like that. You know, borrowing capacity have inflated above the debt to income ratio of 6, above 6. So for every dollar you earn, rental income, salary, things like that, this is how much you in debt. Was in debt. They don't really. It seems like borrowing capacities have exceeded those ratios. That ratio never used to be an issue the last couple of years, but it's certainly surfaced now. So, you know, they're taking their own precautions to cap, you know, the maximum LVR, you know, maybe from 80% to 75%. There is good news though. There are some lenders who are increasing their borrowing capacity, like they've reduced their assessment rate. So when you apply for a loan, they normally have a buffered rate, you know, the interest rate plus the buffer.
Oh yeah.
Yeah, and then they assess your interest rate at that higher rate. That one of the lenders have decreased that as well. So that's good news for borrowers who are looking at borrowing. There's lots of grants and everything like that, and I think that's probably, I might share the screen now in terms of the demand for credit. So can you see the screen there?
Yeah.
Yeah. So what we're looking at here is just the mortgage activity. The mortgage activity, the grey line is what it was last year. The blue line is what it is this year. You can see there that we're kind of faring a little bit better than what we were at the same time last year.
Yeah.
Looking down at the loan purposes, refinances, they used to be up to like almost 66% 2 months ago or so. But that's slowly decreased, and yeah, the purchasing has kind of come up a little bit more because this report's, what is it, weekly, Deb?
Weekly.
Logic. So there is a lot of activity, I guess, in the credit space. Service levels from lenders have improved, but there are a few that are still struggling with the service levels.
What do you mean by service levels?
Sorry, yeah, in terms of processing, how long it takes for them to there are still some who are lagging behind. yeah, it seems like the major lenders are competing quite strongly in the fixed rate space. That just seems to be, it's really odd to see, you know, some of the majors competing or pricing their products cheaper than, you know, some of the non-major lenders, non-major banks. So that's interesting to see as well. So there's a few things that are happening. I think there isn't a clear sign or roadmap in terms of which way lenders are going. They're all kind of managing their own risks, from what I can tell. So it just seems based on what their risk profile is and what they want to do versus what their competitors are doing. They're kind of reacting to that, which is what they normally do. But there isn't. Sometimes there are changes, or you know, Catalyst kind of has changes, which we'll see like changes cascade through the major banks and all the lenders. It'll just kind of come through. It could go from top to bottom or bottom to top. But I'm not seeing anything really major in that circumstance. So there's a lot of space happening in terms of there's a lot of things happening in terms of what could happen in the credit space.
Yeah, and just a comment. Like I can't recall banks offering such high amounts of benefits to entice people to change
lenders.
Yeah, change lenders.
It's massive. The amount of you're talking about the refinance cashback offers, like that. Yeah, even lenders are offering like not having to pay lender's mortgage or paying $1 for lender's mortgage insurance if your loan is not more than 85% LVR. There's a lot of grants out there at the moment. One of the there's been a release of 10,000 spots.
Yeah, another
first home loan deposit scheme.
Yeah,
There is a slight difference between. It's considered the new first home loan deposit scheme because this one's only eligible for people who are purchasing new property.
All right. Oh, yeah.
This is more aligned to the government's agenda to kind of stimulate the economy and have things
the market.
So the old first home loan deposit scheme, I believe all the spots are taken. So that was for either new or old. But the new batch that has come through, it's geared towards new property. But yeah, there's been a lot of first home buyer inquiries that I've received who are trying to work out, what all the grants are. There's a lot of grants out there at the moment, and adding the offers from lenders and things like that. There's a few things to kind of keep tabs on.
Yeah. Okay. Right. So.
Yeah. So that's it from me. All right. Give me one moment.
Yeah. I know what you're saying.
Thanks for watching and joining us for this Property Mythbusters session. We'd love you to receive your feedback. So please join our group and send us any questions or myths that you would like busted. You can contact us directly on our social media or websites. Alternatively, contact us directly through our emails, which is Debra at propertyfrontline.com.au, John at realpropertymanager.com.au, and Ken H at avvora.com.au.
Alrighty. Thank you. Bye.
Thanks for listening.